I really want you to live life. I don't want you to carry the burden of your investment portfolio. We carry that for you so you can do the things that you enjoy doing and that you're good at.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Darryl Lyons.
Hey, this is Darryl Lyons, CEO and co-founder of Unpacks Financial Group, and you're listening to Retire in Texas. This information is general in nature. It's not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. Hey, thanks for joining me. Want to encourage you to like and subscribe. Of course, I hear that all the time. I know you do, and it's legit for podcasters just to make sure that people know what you're doing. So do that for me if you can, if you'd like to. But I really kind of like to synthesize what's going on in the market in a way that you can capture and understand and apply. And I'd love to do it. I look at life through a biblical worldview. Sometimes I talk about that on the podcast. Sometimes I don't. And then I also like to not use a lot of numbers. So if you're kind of thinking about what's the profile of this podcast, it's for me to be able to translate some of these financial things that are happening, make them very relevant to you, and then do in a way that you can say, man, I understood what you were saying. So I love it when people come up to me and say, man, I get it. Like the way you explain it, I get it. And this one is going to be a little tricky because I have to talk about bonds. And I've done this before, but it's so important because the bond market is like, it is really the whole world is hanging not on a thread, but it's kind of on the bond market. The bond market's a really, really big deal. And so I want to explain a little bit about it to you so you can understand the magnitude, and maybe things will start to make sense as you turn on the news and you hear something about raising rates or lowering rates and Jay Powell and Trump fighting. I want you to just kind of understand a little bit of those nuances. And so then I also want to make sure that you understand how it applies to you. Now, if you're younger, you probably don't have bonds in your portfolio, but if you're retired or retiring, you have a chunk of your money in bonds. Sometimes it's 40%, sometimes it's 30%. I'm still inclined at many ages, to lean into stocks. I think the profile of a stock is very attractive in the fact that you have ownership in a company. There's management that has an alignment and an incentive to be able to drive that company to success, pay dividends, or grow. So I love stocks. I think it's really important. It's really an opportunity for America to have ownership in a company. So I'm a big fan of stocks, of owning companies and using the stock market as a vehicle to own those companies. The bond market is kind of a supplement to stocks. So I wouldn't say like, hey, I'm a raving fan of bonds, but I see how they work in portfolios. But I like to talk about them periodically because you have more in your portfolios. You have more bonds in your portfolio than you probably know. And the world economy is really depending on the bond market. So you've got those two things going on, both like the world and your own personal portfolio. So, bonds are a loan that you make as a consumer, you make to a company. So you're lending money to AT&T, and AT&T saying, I'll promise to pay you back in 30 years or 10 years or 2 years. Usually not 2 years on those corporate bonds, but they'll pay you back. So let's say it's, $25,000 and you lend AT&T $25,000, they'll pay you back as long as they're still in business in 10 years. And then in the meantime, they'll send you money, an interest, a coupon every 6 months or so. And so those coupons are really a nice way to, supplement your income, especially when you're retired. It's low risk, low thrill. Those coupons pay your Netflix bill. So that's how I think about those bonds and how they work in your portfolio. So it sounds pretty simple. You're lending money to a corporation. Now you also lend money to the government. These are often called treasuries. And they're inside of your portfolio. I promise you, you could look in there and say, I'm lending money to the United States government. Is that a good thing or bad thing? Like, I'm kind of nervous. I think it's a good question to ask. Hey, I'm comfortable lending money to Apple because I see that they're selling a lot of phones. and I'm comfortable lending money maybe to AT&T. I'm comfortable lending money to Netflix, whoever. But, the government, you're saying I am in my portfolio right now, Darryl, you're saying in my portfolio, I have something called treasuries where I'm actually lending money to the United States. Like, tell me if that's a good thing, because I'm confused. I understand the government has a lot of debt. So that's kind of what I want to unpack for you. So sorry to be long-winded to get there, but how does it relate to, how does the government debt and the J-Powell interest rates and the Donald Trump tantrums with J-Powell, how does it relate to you? Because you actually are lending money to the government and you probably don't know it in your portfolios. And it's not a bad thing. It's just, I want you to know how the game works a little bit. Because traditionally, like 50 years ago, these bonds were just really like I said, low risk, low thrill coupons that paid the Netflix bill. But back in the day, it was paid the electricity bill. And the coupons, it was very systematic. You got your check each month, and it was really easy, and there wasn't a lot of complexity. This is a totally different game today. So the question that I often ask is, if it's a totally different game, can we rely on the historical returns of bonds to forecast what somebody's future might look like? That's a question I ask myself all the time. And we probably won't be able to answer that because I think it's an ongoing question. I'm going to synthesize this conversation into 4 points. And this is about how I want you to relate to bonds. And now, if you don't own bonds, your parents probably do, or your grandparents do. So stay with me. And also, I want you to navigate the government conversation in conjunction with how it relates to you. So let's go through this. There's 4 points I want to make with bonds. First of all, I want to tell you to stay nimble. Bonds zig, stocks zag, and usually it's a good thing that they behave that way. So the thesis behind bonds is that when stocks throw a tantrum, then everyone kind of runs to the safety of bonds. Okay, that's kind of the thesis behind bonds. However, if you look at your portfolio or anybody's, whether you're with Pax or anybody's, I've seen this across the board. If you look at 2022, diversification did not win. Stocks threw a complete tantrum, and bonds did too. So both of them, that diversification did not work. It's like what we're looking at portfolios saying, why do we even own bonds? They didn't even work. And then if you look at this year, that's April 2025, you look at the Liberation Day. Again, stocks and bonds both reacted negatively. And we call that, highly correlated, and we don't like it when we like diversification. And so we're asking ourselves as asset managers, is diversification lost in bonds? I don't think so. There's not enough evidence there needs to be a lot more evidence to make the claim that bonds have completely lost their shine in diversification. But we're seeing some problems where they're highly correlated, where we're not getting that safety feature. So one of the things I want to tell you is to stay nimble with your portfolio, because there's a lot of different types of bonds. And some bonds are working better than others. So they have something called short duration bonds. And I won't get into duration, but it's basically a present value future cash flow calculation. But the shorter duration have, typically less risk associated with it. Higher quality. So, having junk bonds in your portfolio might be the same type of risk as stocks. So we have to be nimble to say what types of bonds need to be in our portfolio given the current risk that exists in the marketplace. And in our current state of risk, I'll talk about that in a minute, but it's also relative to what Jay Powell might do if he lowers rates, and that's anticipated to happen later this year. But so we look at the rate environment and the risk environment, but I think it's staying nimble in our bond portfolio, making modifications, not necessarily to time the market, but making adjustments and at least take an inventory. Do I have too much junk? Do I have too much long-term stuff in it? The second thing I want to make sure that you do is just stay on top of it. And I really want you to live life. I don't want you to carry the burden of your investment portfolio. We carry that for you so you can do the things that you enjoy doing and that you're good at. And that's what an advisor does. A good advisor takes that burden off you. But I'd like for you to stay on top of it just a tiny bit. And let me talk about auctions for a second. I'm not talking about like cattle auctions or the fast talking auctioneers. Those are fun. I'm talking about the bond auctions. In June of 2025, what the government does is they auction off bonds, and people buy them. Institutions, sovereign nations, and you and I. Like I said, they're in our portfolios. So, what happens if the government has too much debt and they're going to collapse? Do you think anybody at these auctions would buy the government bonds? Of course not. And they do hundreds of auctions each year. So here's what I'm trying to tell you. Whenever they do an auction, and if nobody's buying those bonds, we've got some problems in our country, because everyone collectively, sovereign nations, you and I, institutions are saying we don't trust America. So what happened in June of 2025? They had an auction. And did people buy the bonds? Heck yeah, they bought a ton of them. That is very important blood pressure gauge, because everyone was still saying we trust the United States. So despite what you're seeing on TV, the auctions tell us that people are not giving up on the United States. And the other thing to know is that the collective wisdom of the markets will demand a certain interest rates. Let's say they say, well, we'll buy the bonds, but we want 4.84% over the next 30 years. If they start getting really nervous collectively about the United States' ability to pay back those bonds, they being the collective everyone, is going to say, I'm going to need a lot more than 4.84% to take on that risk. So my point in that is that if you stay on top of this, what's going on, and you see the auctions, and the auctions are demanding a higher interest rate, then we're starting to see some stress. That blood pressure is going up in the United States. We're not seeing that right now. And we've seen this in other countries. Greece in 2022, you know what they had to offer the consumer to invest in bonds? They had to offer them like 30% because nobody wanted to touch Greece bonds. It's just a great blood pressure medicine for the for the collective market. And I know, look, the United States, for every dollar they spend, or for every $5 in revenue, they spend $1 towards just paying interest. It's a train wreck, and it does weaken confidence. But you can measure that blood pressure by the auctions. So I'm just saying that we're the United States, we're the cleanest shirt in a dirty load of laundry, but there's quantitative and objective ways to measure the health of the country, and the auctions are one way to do it. I doubt you'll watch it. I doubt I'll watch it, all 100 of them, but if you hear about them, at least you'll know a little bit more. Okay, third. I need to land this plane because I'm running out of time, but lots to talk about in a shorter period of time. But the third one is I do have conviction that you need to stay in professional management. The bond market is complex. It's massive. There's all kinds of bonds, high quality junk, international municipals. It's like the mega Chinese buffet of investing. It's huge. And so I like professional management. I've flown out to see professional managers in East Coast and West Coast. I think about PIMCO being kind of the big stud in the business. They have 265 portfolio managers in 23 offices around the country. I'm not advocating you be in PIMCO. It's just one of the asset managers we use, but they do a ton of credit research, making sure that companies are solvent, they're going to pay back, stress testing. They might find fallen angels or rising stars. It's just insane, the amount of research and the amount of intelligence that exists in the bond market. And I juxtapose that with us as consumers. And I saw a report the other day about how consumers and investors, retail, we call them retail investors, you and I, independent of institutional professional managers, how we buy bonds. And it was an interesting chart because it showed that there was a material disparity in returns, because retail investors, when they're in the bond market, they chase returns. So what they do is they look at their statement and go, man, that bond and that I should have owned did better the last 6 months, and then they switch. And so what's happening for retail investors that don't use professional managers is they totally fumble it. And the evidence is clear. Just don't try to chase these bond returns. It's an impossible task. And I think professional managers, there may be a cost associated with using them, but I do have conviction that they're much better at navigating these hundreds of auctions of that exist in the United States, in the corporate market and sovereign market. I heard a lady, she's at Charles Schwab, I was on a conference call. Her name's Kathy Jones, and she said this. She says, bonds will continue to do their job, but there will be dislocations. So my point is don't do it alone. When those dislocations happen, it's good to have professional management. Okay, last thing. I just want you and me and all of us to stay calm. There's ways to objectively determine if there's problems in the marketplace. And there's a lot of headline risk when it comes to the markets. Continue to stay calm. The bond market will have stress. There will be, some fragilities in there. Rates are moving. Of course, government mismanagement is real. I just don't see a reason to panic. I think we proceed with caution with bonds. We're trying not to overextend ourselves. Make sure that your advisor has you in the appropriate portfolio for your risk. There's two elements of bonds to consider, and this is a little bit of an exit ramp, but let me just make sure you hear this. They use secular trends, which is a long-term approach to bonds, and then cyclical. So you might hear that's short-term. We're very much thinking about the secular trends, holding bonds long-term. So again, going back to the original premise, a bond is a loan, and the idea behind it is that company or that country is going to pay you back in 10 years. And it's my conviction that these companies and countries, if done right, they will pay you back in 10 years. In the interim, the bond market can, go up and down, but that contract still exists between you and the company. So if you have a long-term time horizon with bonds, I don't have concerns. I just have concerns about the short term, and sometimes sitting down with the client and say, hey, because of this situation, we didn't get the diversification. We just have to navigate through those conversations because they'll happen, and we can't chase returns. I think my first point in staying nimble is just reevaluating with your advisor the construction of your portfolio, but not chasing returns. Just continue to stay calm, get the right team around you, the right strategy, and of course, the right mindset. Okay, so let's wrap up. So that's kind of a helicopter overview of bonds, how they work, and how it impacts your investment experience. Number one, stay nimble, adjust when needed. Two, stay on top of it. Just know that there's sophisticated yet complex markets that have objective ways to determining if things are collapsing or not. So just be aware of those options. Three, stay in professional management. I don't believe that bonds are a do-it-yourself project. Not anymore, for sure. And then last, stay calm. It's complex, but it's only chaos if you don't have a plan. So I hope all that helps. There's a lot of noise out there. I still believe that bonds play a key role. I believe that going forward, it is important for us to be cautious. And I would also say I still have more conviction owning good companies. So if you were to say, do you like stocks or bonds more? I'm a owning company kind of guy. I think that's the best way to accumulate wealth long term. But regardless, diversification is still important, and bonds do play a role. So thank you very much for tuning in today. I hope it was helpful. And remember, you think different when you think long term. Have a great day.